On April 2, 2026, the United States signaled a severe military escalation. President Trump announced Operation Epic Fury, setting a hardline stance. The threat was directed explicitly at Iranian energy infrastructure. Traditional market logic dictates a specific reaction to these headlines. When missiles fly and stability fractures, capital typically seeks safety by flooding into gold. This 1-hour XAUUSD candlestick chart shows the reality. Instead of a rally, gold hit a massive upper rejection wick at $4,821, followed by a 4% red candle crashing into the 4,550s. In a matter of hours, gold lost $150 from peak to trough. Institutional capital exited the asset abruptly, pulling out with enough sheer force to drain market liquidity almost instantly across the board. This drop represents a predictable cross-asset cascade, structured to absorb retail traders who bought into the geopolitical headlines. In institutional order flow, a bull trap uses a false signal of an upward trend to lure in late buyers, only for professional sellers to use that buying pressure to close their own positions. As gold pushed above the previous London high of $4,774, retail trading algorithms were systematically triggered to buy the breakout. These buyers entered directly into a liquidity wall, a predefined level where smart money distributes positions. This 4-hour chart reveals the architecture of that wall. We draw the 0.618 Fibonacci retracement line, descending from prior highs. Now we layer in the 200-day exponential moving average, intersecting the Fibonacci line at exactly $4,805. This forms a rigid, precise institutional supply wall. Momentum failed at this barrier, culminating in a death cross on the moving averages. Simultaneously, the relative strength index plummeted from an overbought reading above 70 down to 37.4. Institutional traders use the geopolitical headlines as exit liquidity, unloading their positions at a specific, pre-calculated ceiling. To find the cause of this rejection, we must look away from gold and examine the immediate derivative of the conflict, the crude oil market. This line chart tracks Brent crude. We can sync this spike to the exact timestamp of the presidential address, as prices jumped 7.3% to $108.56. Threatening Iranian facilities placed an immediate premium on global energy supply. Sustained oil prices create a path for sticky, persistent inflation across the broader economy. Faced with an energy-driven inflationary shock, the Federal Reserve loses the ability to cut interest rates, forcing borrowing costs to stay higher for longer. March ADP employment data confirms this pressure. The economy added 62,000 jobs, making it too hot to justify rate cuts. Traders responded by selling government bonds, causing U.S. Treasury yields to spike. This creates a massive opportunity cost for gold. When risk-free government bonds pay high returns, large capital allocators pivot away from zero-yield assets. By threatening oil infrastructure, the geopolitical shock transformed into a yield curve shock, making gold toxic to institutional portfolios. Capital migrated to the U.S. dollar, the high-yield haven of choice in this high-risk environment. Looking at this dual-axis chart, the correlation is clear. As the U.S. 10-year yield climbs on one axis, the DXY line crosses above the critical 100.00 threshold. Because gold is priced in dollars, a surging dollar index exerts a mechanical suppression effect, automatically driving the dollar-denominated price of gold down. Iranian President Masoud Pezeshkian questioned the economic logic of the escalation, noting the irrationality of the U.S. demands. But market mechanics ignore political rhetoric. Institutional capital evaluates risk solely through the lens of yield and liquidity. In an environment defined by both war and stagflation, smart money abandons the non-yielding haven for the one that pays interest. Beyond the intraday trap, there is a structural argument for gold, the assumption that central banks will buy and hold reserves, creating a permanent floor. The February 2026 World Gold Council statistics test that assumption. This bar chart visualizes the sovereign gold landscape, separating net buyers from net sellers. We see persistent buyers in Poland, which added 20 tons, and Uzbekistan, which acquired 8 tons. But on the other side, Turkey sold 8 tons, and Russia liquidated 6 tons. The reality is that conflict-strained nations are being forced to sell gold reserves to finance defense spending and manage budget deficits. Turkey utilized roughly 50 tons of its reserves in a single month purely for foreign exchange operations and liquidity. With major nations liquidating reserves to survive, the structural floor for gold is fractured. This weakness validated the technical sell-off. Returning to the current XAUUSD chart, we can assess the damage. This 1-hour chart shows where the bleeding stopped. Buyers attempted to build a rigid support band at the $4,617 level, and that level aligns with the 50-day moving average. This line is the boundary between a standard market correction and a total structural trend collapse. Institutions rarely buy at a support line without a liquidity sweep, a quick dip below the floor to trigger stop losses and absorb the shares. They also require algorithmic confirmation, such as the 20-period whole moving average flipping from bearish to bullish. Without that sweep and algorithmic confirmation, buying this dip is gambling against institutional momentum. We must also calculate the bearish capitulation scenario. What happens mechanically if that $4,617 support fails? The next downside target is a massive liquidity pool resting at $4,480. If the 50-day moving average breaks, the resulting drop will be violent as stop-loss orders rapidly cascade downward. The impending non-farm payrolls report is the catalyst capable of breaking that support. The April 2026 crash demonstrates that gold prices are now detached from isolated geopolitical fear. To predict how gold will react during a conflict, you must track the crude oil derivative to determine inflation expectations. In modern institutional markets, geopolitics is traded as a yield curve event. Those who trade the raw headlines will become